Connecting the management business to earlier lessons. In earlier sections, you learned what property managers do day to day, how management agreements define the relationship between owner and manager, how leases are structured, and how risk management touches every decision. This section zooms out one level. Instead of only asking, how do I manage this property? You now ask, how do I build, protect, and grow a property management business? As a salesperson or future broker, this is the difference between handling a single rental as a favor and running a professional management operation that attracts owners, survives audits, and produces long-term income. Sources of property management business. The demand for property management has grown as more people invest in real estate and as properties become more complex. A single investor might own one small rental home, while another investor might own an entire retail center, office building, or cluster of vacation rentals. Each of these owners has the same basic problem. They cannot or do not want to manage the property themselves. That need is the starting point of the management business. Property management business often comes from owners who already know you through sales. For example, you might sell a home to an investor who then asks you to handle the leasing and ongoing management. Builders and developers who cannot sell all their inventory may convert some units to rentals and ask a manager to step in. Banks and asset managers handling foreclosed or distressed properties may hire property management firms to stabilize and operate those assets until they are sold. Homeowners associations and condominium associations also need managers to coordinate maintenance, enforce rules, handle budgets, and interact with owners. In some markets, mobile home parks, resort communities, and vacation properties create yet another stream of management opportunities. The key idea is simple. Anywhere there is income producing or common interest real estate, there is potential management business. Specialist opportunities and niches. Property management is not a single job. It is a family of specialties. A manager who understands this can choose a niche that fits their skills and local market. One manager might focus on leasing residential single-family homes and small plexes, building relationships with individual landlords. Another might manage large apartment communities for institutional owners, where the work feels more like running a small company with staff, marketing, and capital improvement projects. Some managers specialize in asset management, which is focused less on daily maintenance and more on long-term financial performance. An asset manager studies revenue trends, expenses, and capital needs to help owners decide when to renovate, when to refinance, and when to sell. Corporate property managers focus on real estate used by businesses for their own operations, such as offices or warehouses, making sure locations support the company's strategy. Resort managers work with vacation properties and sometimes hotel-style operations, dealing with short-term stays, seasonality, and high guest expectations. Association managers handle the business of homeowners and condominium associations, coordinating common area maintenance, assessments, and rule enforcement. Mobile home park managers must understand both real property issues and often personal property and space rental regulations. Office building managers deal with multi-tenant professional space, coordinating security, parking, and building systems. Each niche has its own vocabulary, legal issues, and business cycles. A manager who becomes known as the person who really understands small apartment buildings, or the go-to expert for HOA management, can build a steady stream of referrals from owners, brokers, and other professionals. Securing new management assignments. New management business does not appear by accident. Owners choose managers based on reputation, demonstrated competence, professional training, and how clearly the manager can explain their services. Before you sign a management agreement, it is critical to make sure the owner's objectives are clear and realistic. Some owners want to maximize current cash flow, others want to maximize long-term value, and still others want to minimize headaches, even if that reduces income. Imagine an owner who says, I want top rent and zero vacancies and minimal maintenance spending. An experienced manager knows that those goals conflict. Top rent often requires upgrades and a willingness to accept some vacancy. Minimal maintenance leads to long-term damage and lower rents. Before agreeing to manage, you would talk through these trade-offs and help the owner set priorities. This conversation protects you later. If, for example, the owner insisted on underfunding repairs and the building's condition declines, you can document that you advised otherwise. Smart marketing also matters. A management firm might build a professional website explaining services and pricing, present case studies for past clients, and maintain active relationships with sales agents who refer owners. Networking with lenders, attorneys, accountants, and association boards can also produce new assignments. In every conversation, your risk management knowledge is a selling point. Owners are reassured when they see that you understand landlord-tenant laws, fair housing, trust accounts, and record keeping. The management plan. Once a manager and owner agree on objectives, the next step is the management plan. Think of this as a written blueprint for how you will operate the property to meet the owner's goals. A well-prepared plan can help you win the assignment and then guide your day-to-day decisions. A management plan looks at 3 broad areas. First, it clarifies the owner's goals. Does the owner want maximum cash flow now, even if that means less long-term appreciation, or a balanced approach that funds reserves and capital improvements? Are there specific benchmarks, such as maintaining occupancy above a certain level or achieving a target net operating income? Second, it analyzes the market. The plan should consider vacancy rates, occupancy rates, the pace at which comparable properties are being leased or sold, and new supply coming online. For example, if several new apartment communities are opening nearby with upgraded amenities, you may need to plan for renovations, rent concessions, or targeted marketing to keep your property competitive. If industrial space in the area is in short supply, you might be able to justify higher rents or more selective screening. Third, the plan addresses the property itself. You will review its current condition, layout, systems, and amenities. You will build a budget that projects income based on realistic rents and occupancy, and that estimates expenses such as maintenance, utilities, taxes, insurance, management fees, and reserves for capital items like roofs or HVAC systems. The plan should explain what you intend to do in the first year. That might include adjusting rent levels, improving curb appeal, tightening up rent collection policies, or addressing deferred maintenance. A good management plan is not a one-time document. It is revisited annually and adjusted as the market, property, and owner's needs evolve. Professional development and designations. Because property management is a sophisticated business, owners and investors often look for managers who have formal training and professional designations. These credentials signal that you have studied best practices, understand legal and financial issues, and are committed to ethical standards. Several organizations offer education and designations in property management. Some focus on broad commercial and residential management, others on apartments, and others on retail or single-family properties. Earning a respected designation typically requires coursework, examinations, and documented experience. For example, some programs emphasize budgeting, capital planning, and building systems. Others focus on leasing, maintenance coordination, and resident relations. Belonging to a professional association can also provide ongoing benefits. Members often have access to legal updates, sample forms, networking events, and specialized conferences. A manager who attends regular training is more likely to stay current on changes in fair housing guidance, landlord-tenant laws, building codes, and environmental issues. From a marketing standpoint, listing your designations and association memberships in proposals and on your website helps differentiate you from untrained competitors. Owners may reasonably believe that a manager who invests in professional development will also invest energy in protecting their property. Property management, records, and compliance. As you saw in earlier risk management discussions, good documentation is your best defense when something goes wrong. Property management firms have specific record-keeping duties that go beyond ordinary sales transactions. Regulators expect property managers to maintain detailed, organized records that can be produced for audit. Residential rental agreements and related documents must be kept for a defined period after the rental agreement expires or until they are turned over to the owner at the end of the management relationship. Related documents include applications, move-in and move-out condition reports, lease amendments, notices of default, and correspondence about lease obligations. These records must be stored at the broker's main office or at an off-site storage location within the state. If records are stored off-site, the broker must provide written notice of the storage address to the real estate department. Finder fee records require special attention. If a property management firm or owner pays tenants a limited referral incentive for bringing in new residents, the firm must keep records of those payments for a set period, again, often 3 years, or until the records are given to the owner at the end of the management agreement. These records show who was paid, how much, when, and for which referral. Keeping them accessible at the main office or properly reported off-site allows regulators to verify that the firm is following the law. Financial records are especially important. Property management firms must keep all client-related financial records, such as bank statements, canceled checks, or bank-generated images, deposit slips, receipts, disbursement journals, owner statements, client ledgers, bills, invoices, and statements for at least several years from the date each document was executed. These records document every dollar that enters or leaves an owner's trust account. When regulators audit, they will compare trust account balances with ledgers and owner statements to confirm that funds have not been misapplied. For non-residential lease transactions, transaction folders must be maintained in a systematic way, often using chronological logs or another orderly method. These folders should include confirmation that all deposits or other monies were handled according to the parties' instructions, a complete copy of the lease or rental agreement, and, when applicable, a copy of the listing agreement. Residential rental transaction folders can be organized according to dwelling unit number or another system as long as the records are easily accessible for audit. Brokers are generally not required to maintain duplicate residential rental transaction folders, but they must be able to produce complete records when the regulator asks. Only the designated broker or an authorized licensee may sign non-residential rental agreements on behalf of the brokerage. Any delegation of that authority must be in writing and kept in the broker's employee file. Residential leases may not require the same review and initialing as contracts for the sale of real estate, but many brokers still adopt internal procedures to spot problems early. When the regulator requests records for a routine audit, the broker must make property management account records, lease agreements, lease-related documents, and trust account records available within a reasonable time. The audit is generally limited to business activities that relate to the accuracy of the broker's handling of client funds and documents. But if there is suspicion of violations, the regulator can expand its scope. A firm with organized records and clear procedures will find audits straightforward, while a firm with missing or chaotic records is at risk for discipline. Finder fees and tenant referral programs. Many apartment communities like to reward existing tenants who refer new residents. These rewards are often called finder fees. Because property management involves licensed activity, laws draw a careful line between acceptable tenant referral incentives and unlicensed real estate activity. In general, a property management firm or property owner may pay a small finder fee to an unlicensed tenant in an apartment complex for referring prospective renters. The reward is usually limited to a credit or reduction in the tenant's rent, capped at a modest amount such as $200 per referral. A tenant may receive multiple finder fees, but only up to a maximum number of times, such as 5 times in any 12-month period. These limits prevent tenants from essentially operating as unlicensed leasing agents. The tenant's activities must also be limited. They may introduce or refer prospective residents to the owner or the owner's agent, but they may not show units, discuss lease terms or conditions, or negotiate with prospects. They also may not advertise or promote referral services to the general public. If a tenant crosses those lines, regulators may treat them as engaging in unlicensed practice, and the licensee who encouraged or paid them could face discipline. Only the owner or property management firm may decide to offer tenant referral credits, and they must be careful not to pay finder fees in violation of statute. A licensee who pays illegal finder fees can face suspension, license revocation, or civil penalties. Clear written policies, staff training, and accurate record keeping of all referral credits help managers use tenant referrals as a marketing tool without violating licensing laws. Review summary. This section stepped back from individual leases and maintenance issues to show you the broader property management business. You learned that management assignments come from many sources, including individual investors, institutional owners, builders, associations, and lenders. You saw that property management offers numerous niches, from small residential portfolios to large commercial assets, and that specializing can help you build a strong reputation. You examined how managers secure new business by clarifying owner objectives, presenting realistic strategies, and using reputation, competence, and marketing to stand out. You learned that a management plan is a written roadmap that integrates owner goals, market analysis, property characteristics, budgets, and proposed actions for the coming year. You explored the role of professional development and designations in signaling expertise and maintaining current knowledge. You saw that belonging to professional associations and earning recognized credentials can help you compete for sophisticated owners and complex properties. You then focused on record keeping and compliance, learning how long residential rental agreements, finder fee records, and financial records must be kept, and how they must be organized and made available for audits. You saw that clear, systematic record systems and careful trust account management are essential to regulatory compliance and risk control. Finally, you looked at finder fees and tenant referral programs, learning where the law draws the boundary between simple referrals and unlicensed activity. You saw that modest, structured rent credits for referrals can be legal when tenants merely introduce prospects and do not show units, negotiate, or advertise services, but that violations can lead to serious penalties for licensees. Discussion Prompt 1. An investor with 10 single-family rentals asks you to manage them. He wants top market rent, minimal vacancy, and minimal spending on repairs. Based on what you have learned, how would you structure your initial conversation and management plan with this owner? Suggested answer. You would begin by clarifying his objectives and explaining the trade-offs among high rent, low vacancy, and low maintenance spending. You might show local vacancy and rent data and explain that achieving top rent usually requires well-maintained properties and occasional upgrades. You would discuss the importance of funding a maintenance and reserve budget to protect long-term value. In your management plan, you would propose a realistic rent strategy, a schedule for needed repairs, and occupancy targets based on market conditions. You would document the agreed priorities, so there is a clear record of what success looks like and what level of spending and risk the owner has accepted. Discussion Prompt 2. During an audit, a regulator requests all records related to a non-residential lease you handled 3 years ago. What records should you be able to produce, and how should they be organized? Suggested answer. You should be able to produce a transaction folder that includes a complete copy of the non-residential lease or rental agreement, any listing agreement, correspondence, and confirmation that all deposits or other monies were handled according to the party's written instructions. You should also be able to produce financial records related to that transaction, such as trust account deposit slips, checks, ledgers, and owner statements. These records should be organized in a chronological log or other systematic manner that makes them easily accessible, either at the main office or at a properly reported off-site storage location. Discussion prompt 3. A new apartment owner wants to offer unlimited cash payments to tenants who bring in new residents and wants those tenants to show units and help close the leases. How would you respond as a property manager? Suggested answer. You would explain that paying unlicensed tenants unlimited cash for activities that look like leasing can violate real estate licensing laws. You would describe the legal framework for finder fees, including limits on the amount, the number of times a tenant can receive a fee, and the restrictions on what tenants can do, such as not showing units, not negotiating terms, and not advertising services. You would recommend a compliant referral credit program that uses small rent credits within allowed limits and keeps tenant activities confined to simple introductions. And you would document the policy in writing. Closing remarks. Running a management business is more than collecting rent and calling repair people. It is a professional service that requires planning, specialization, training, careful record keeping, and strict compliance with law. As you apply these ideas, remember that your ultimate role is to be a trusted steward of other people's assets. Owners will judge you not only on the income you generate, but on how safely and transparently you handle their properties and their money. With a solid management plan, strong professional development, disciplined records, and lawful referral practices, you can build a management business that is both profitable and resilient.